Okay. You might be listening. When you get please respond so that we able to continue our session. Otherwise, we should look into if there is any technical problem.
Getting better, but still not clear.
Okay. So, you can continue the
Yeah.
I hope my voice is reaching you. Now it is clear. Please respond so that uh, okay, fine. So, Assalamu alaikum. This session is basically to financial instruments and this area we covered is very important tomorrow. And we will take total 9 hours to cover this area. So, under financial instrument, first of all, we shall discuss International Accounting Standard 22. Then we shall discuss International Financial Reporting Standard 9. Impairment, I separated impairment area so that I could help you people practically how can you apply the guidelines given under impairment when your what are the new requirements of impairment and what are the old requirements of impairment so that you could appreciate the difference but in fact you are required to apply the new requirements. So that's why we shall be discussing impairment area separately. Then we shall be discussing hedging area separately. And at the end, we shall cover IFRS 7 related to the disclosures of the financial instruments. Uh, we are taking almost 9 hours to cover financial instruments, but the depth of the topic is such that 9 hours may not be sufficient. So that's why I try to select those areas where we can discuss and we can conclude constructively so that whatever we discuss there, that is not only understandable, but that should give you benefit in your practical life. So we shall be taking up those matters from 32, IFRS 9 and 7, which are really helpful for you people while applying these guidelines practically. I would like to share one more thing, and I am thankful to Almighty Allah as well. Actually, so far as the impairment and hedging is concerned, I was given an opportunity to represent Pakistan last year. I presented impairment and hedging in last year, and that conference was attended by around 1,000 people. 263 audit firms all over the and that has given me the opportunity to represent Pakistan and to present financial instruments, especially focusing on impairment and hedging and other main changes in the financial instrument and how it affects the Iranian industry. What should be the measures they should take in order to implement the guidelines given in IFRS 9. Currently, in fact, they are applying International Accounting Standard 39. So as in people, so have a notebook and pen ready just to uh, all calculations so that you could appreciate the concept there and then when you discuss the classification. Similarly, be attentive and because concepts are packaging, so it is so it's better if you are sitting in groups key point so that the hearing of other people's is not impaired. And similarly, you can ask questions. We shall be having frequent question answer break. I will try to take your question when I feel that I have discussed a concept. I could answer your question right after that particular concept so that any confusion can be addressed immediately. Okay. So first of all, financial instruments. See, financial instruments. Financial instruments is basically a contract that gives rise to a financial asset of one entity and a financial liability or instrument of another entity. It's basically a contract, and on one side you will find financial asset of an entity, and on the other side a financial liability or an equity liability. Of when we talk about the assets and the liabilities, statement of financial position immediately comes to our mind. The definition describes financial statement as contracts, financial instruments as contracts. Therefore, in a sense, financial assets, financial liabilities, equity instruments are going to be pieces of paper.
So let me check with the voice again, once again. Lots of people are saying that they cannot hear us. Please let me know rather some people are saying that voice is not clear. Please tell us that if you can hear us clearly. I need a little feedback from you guys. Voice is not clear, not clear, breaking. Okay, let me recheck with my other audio.
financial asset of one entity and financial liability or equity instrument of other entity. This is basically a contract. See, with reference to assets, liabilities, and equity instruments, the statement of financial position comes to mind. Further, the definition describes the financial instruments as contracts. And therefore, in a sense, financial liabilities and equity instruments are going to be pieces of paper. See, for example, when an invoice is issued on the sale of goods on credit, the entity that has sold the goods has a financial asset, that is the receivable. When you sell goods on credit, so receivable is created. So this receivable is your financial asset, while the buyer has to account for a financial liability, a payable. Another example is when an entity raises finance by issuing equity shares. See, the entity that subscribes to the shares has a financial asset because they have invested, that entity has invested in the shares of another company. This investment is their asset, is its asset. So this is their financial asset. While the issuer of the shares who raised finance has to account for an equity instrument, equity share capital. Third example is when an entity raises finance by issuing bonds, debentures. The entity that subscribes to the bonds means that lends the money has a finance asset, an investment. While the issuer of the bonds, that is the borrower who has raised the finance, has to account for the bonds as a financial liability. So when we talk about accounting for financial instruments, in simple terms, we are really talking about is how we account for investment in shares, investment in bonds and receivables, and how we account for trade payables and long-term loans, financial liabilities, and how we account for equity share capital, mean equity instruments. So these are the basically financial instruments, like your receivable, your payable, your long-term debt, your equity instrument, and then investment in bonds, investment in shares, your account receivable, your account payable. All these are financial instruments. We can look at some of the examples of. We can look at some of the examples of financial instruments. Financial instruments are basically, like for example, as I mentioned earlier, trade receivable. See, this is the trade receivable. This is financial asset of one party, whereas uh, another party who will be paying this money, who has bought the goods from this first party, for them this is a financial liability. We saw the definition. Like for one party, the financial instrument will be a financial asset, and for the other party, this will be either financial liability or an equity instrument. This is the first example. Second is like if one party has invested in shares, this investment is basically an asset for that organization. Whereas the other entity who issued those shares, so this will become the equity instrument of that other party. Similarly, holder of redeemable preference shares. So, whosoever holds equity impact. Now the question arises, we have discussed redeemable preference shares here. Again, we are discussing here. Here you can see that these are classified as a financial liability, whereas here these are classified as a equity instrument. Though we shall be discussing this concept at length after some slides, but only very shortly. See, we all know that redeemable preference shares can be or they can. So, what are the factors which will be used? What are the considerations which we should have in mind while deciding whether a renewable preference share is a liability or equity? We shall be discussing this concept after some slide. But for here, you can see that this is a financial asset for one party and equity instrument of another party. So you can hear me now clearly. I suppose. Just answer with yes, so that quickly we can see that instead of keep on discussing, we should have your feedback so that we can see that. The next is another example is finance lease receivables. Lease receivables. See, finance lease receivable. Uh, these are basically financial asset of one party, whereas financial liability of finance lease obligation is basically financial liability of the leasing company. We can see that, like in case of lease, if these are receivable, this is your financial asset, and anything payable under lease will be your financial liability. Receivable means you are a lessor, and for lessor, finance lease and operating lease terms are retained by the International Financial Reporting Standard 16. So, receivable under operating lease, receivable under finance lease,
Are basically financial assets, and the payable on the part of your lessee will be financial liability for your lessee. Likewise, some of these are the basically examples of financial instruments. From all these examples, we have noted that on one side it was a financial asset on one side, and on another side it was either a financial liability or an equity instrument. Okay, this was one. Second, financial instrument can be primary instrument, and financial instrument can be derivative instrument. As we have seen in before these examples, it was written over here like financial instruments include primary instruments and derivative instruments that derive this value from the price or rate of an underlying instrument. All these examples which we have just discussed, these were the example of the primary instruments, in fact. Now we can see a couple of examples related to financial instruments which are basically derivative instruments. These were the examples of the primary instruments. So these are the examples of derivative instrument. Here you can see that buyer of in-the-money options. If you are buyer and your option is in the money, so this is financial asset for you. And on the other side, for that wrote this option, for that organization, this will become the financial liability. We know that what is in the money option. In the money option is in that you will gain, you will make profit if you exercise that option. So that option is normally termed as in the money option. Like if you have an option to buy dollar at the rate of 110. So if open market rate is 120 rupees, so this means by exercising that option, you can buy $1 with 110, and you can sell that dollar at 120. So this will give you a profit of rupees 10 per dollar. So this option will be termed as in the money option. So if you are a buyer of in the money option, if you hold this option, so this is your financial asset. But the other party who wrote this option, who is the which is the seller of this option, for that party, this is basically a financial liability. So this is one example. Another example is forward contract standing at gain. If you have entered into a forward contract with which is a bank or other financial institution or other organization, and you people know that the rate in the forward contract is fixed. So the rate which is fixed may be beneficial for you by exercising, by executing that forward contract, you will gain. So that will become your financial asset. But the other party, of course, will be at loss. If you are at gain, that party will be at loss. We can reverse this situation as well. If you have already entered into a forward contract and that is at loss for you, so of course the other party to the contract will be at gain automatically. For that other party, this forward contract will become financial asset, and for you, this forward contract will become financial liability. Okay. So then there are, see, in brief, financial instrument in fact give you present right to receive cash or another financial asset, and contractual in nature, not imposed by some statutory requirements. So these two things are very important. Like either you receive cash or you receive another financial asset. See, this is basically the understanding. This is basically the understanding, like which we must keep in mind. Like this will be contractual in nature. There will be a contract. Automatically, when we say that there should be a contract, so if something is imposed by the statutory requirement, this will not become the part of this. This cannot be treated as a financial instrument. So we can have a couple of examples related to this, like inventories, property, plant and equipment, leased assets, intangible assets are not financial instruments because their control does not give rise to present right to receive cash. I repeat, because their control does not give rise to present right to receive cash or another financial asset. Similarly, prepaid expense mean future benefits in that will result in the receipt of future goods or services. Mean rather than this is basically, this will also not a financial instrument. Prepaid expenses, prepayments, because in future you will be receiving either goods or services. So for financial instrument, the other side should be a cash. You will be receiving a cash or another financial asset. So these two things, if you are receiving, so then this will be termed as a financial instrument, otherwise not. Similarly, deferred revenue and most warranty obligations are not financial liabilities because the outflow of economic benefits associated with them is the delivery of goods and services rather than a contractual obligation to pay cash or other financial assets. Similarly, liabilities or assets that are not contractual, such as income taxes that are created as a result of statutory requirements imposed by the government and are not financial liabilities or financial assets. Accounting for income taxes, we know, is dealt under International Accounting Standard 12. Similarly, constructive obligations as defined in International Accounting Standard 37, provisions, contingent liabilities, and contingent assets do not arise from contracts and are not financial liabilities. Okay, if you people have any question, so please feel free to ask that question before moving to the next area. I suppose the definition is very clear for one party. Simply trade receivables, trade payables, loans, long-term loans, bonds, debentures, equity instruments, if you have invested in the shares, all these are financial instruments because all these are contractual in nature. All these are contractual in nature, and when they will be settled, either you will be receiving or paying cash or other financial assets. So these are the financial instruments, in fact. Okay, if we
Yes, we have a question from I think Mr. Muhammad Bakir. I would like to ask, what about transition of forward contracts to swaps? How should they be defined? Either as a financial liability at first and asset later? Just confused with its definition and subsequent accounting treatment.
which contract, Muhammad Bakir?
Transition of forward contracts to swaps.
See, forward contract are derivative instrument. When you convert it to the swap is again a derivative instrument. So be clear, both are financial instruments. Muhammad Bakir, I hope it is clear.
Can you kindly explain redeemable preference shares again, as there was severe voice disruption at that time?
Who is this gentleman?
Mariam Alauddin.
Mariam, I will be discussing redeemable preference shares at length after a few slides, because in those slides we saw like in one line we classified them as a financial liability, whereas after a couple of lines we classified redeemable preference shares as equity instrument. So we shall be discussing this concept after a few slides. So there you will find your answer.
Mohammed Ahmed Sadiqi asking if advances paid or security deposits can be classified as financial assets.
Who is this gentleman?
Mohammed Ahmed Sadiqi.
Muhammad Ahmed, simple criteria is very simple. If whenever you get your security back, you will be receiving cash or other financial asset, and that is contractual in nature. Yes, you can.
For options, does not give a clear present obligation. For options where it does not give a clear present obligation, but rather the facility to impose. So how it will be considered as a financial instrument under first criteria?
Who is this gentleman?
Achala Barega.
Achala, can you elaborate your question? Because options option could be of three types, like at any particular and at any point in time. Like an option could be in the money, an option could be at the money, an option could be out of the money. So what you are talking about, so please be clear in your question so that I could answer. Okay, so
No more questions.
Okay, fine. So we can move forward.
Burhanuddin just sent a
Yes,
question.
please.
He is asking, what are the core factors that determines a financial instrument, and what is the nature of contract?
Nature of contract. See, Burhanuddin, contract in the general context of the contract, there is no there is any like a special definition for the contract, as you people have learned from the contract law. Your contract, if it is entered into as per the requirement of that law, so that is a contract. As per the contract law. This is a common law concept. So it has there is nothing special related to the financial instrument. So the same contract as per the common law concept. Burhan, I hope it is clear.
All options give rise to financial instruments. Please elaborate, Usman Yusuf.
Yes, Usman. All options give rise to financial instrument, because if an option is out of the money for you, so this is your financial liability. No, in that case, if you Usman, let me take up three situations separately. If an option is in the money, this is like a financial asset for you, and financial liability for the writer of the option. You are the buyer of the option. If an option is out of the money, so it is neither financial asset nor financial liability for you, because it is neither as financial asset nor financial liability for you. So for other party, the same will be the case. For other party, it will be neither financial asset nor financial liability. If it is at the money, the same is the case as I discussed, but it depends how it moves. If it will subsequently move in the money, then this will become a financial instrument for you if you are a writer, if you are a buyer of that option. Usman, I hope it is clear. There could be different situation, and under each situation, you can decide whether it is a financial instrument or not. Because for financial instrument, it has got to be financial asset for one and the financial liability of other. If an option is out of the money, so this is not beneficial for you. This is not an asset for you. If it is not an asset for you, so we will not be thinking about the other party, because you will not be exercising the right of a writer of the option will not have to meet any obligation. Or even if you exercise it, which is illogical and which is irrelevant, so then that will be a beneficial for the other party.
Before moving to another question,
Usman, please, if you are clear, then I will move further. Or if you have any specific question, you can ask.
Before going further on another question, one of the member appearing to me as offline, I don't know from which medium they can seeing our webinar, but anyhow, he's asking that at my end, I am getting message that organizer have muted. I cannot hear. Although people can hear us, but they cannot speak through their mic. So we have muted their mic from our end, and I think he's getting the message of his mic right now. So other people can hear, and they are even posting their questions as well. So we have a question from Achala Pereira again. My question is, whatever the type of the option, it does not give a current obligation to the buyer, only a right to impose. So it may not satisfy the first criteria you have given in the slide.
Achala, I suppose I pronunciated it correctly. Achala, see, let me explain it to you. Like if we use one empty page from here. Okay, where is it? We can use an empty page from here. This is the see, Achala, for option, for each option, there could be a buyer of that option and there will be a seller of that option, or you can name it writer of that option. Writer of that option. If you have an option to buy $1 for rupees 110, you are the buyer of this option. You can buy $1 for rupees 110. In the open market, if dollar rate is open market, dollar rate is like move to rupees 118. So will you exercise this option or not? Of course you will exercise. And who will be honoring this option when you will be exercising? Of course, the writer of that option. So if at the year end you are holding an option which is in the money, this is your financial asset. Because as per the definition of the asset, this will give you a benefit of 8 rupees per dollar. But for the writer, he is obliged to like sell you dollar at the rate of 110. So option, if you are a buyer of an option which is in the money at the year end or at the period end, this will become your financial asset and the financial liability of the other party. Because you are buyer, this is optional for you, but for the writer of the option, this is binding for him. He will have to settle that transaction if the buyer of the option requires this. I hope it is clear. Can you please check it? If it is clear, then okay.
Yes.
Okay. Okay, let's move further. Let's move further here. We were here. International Accounting Standard 32. First of all, certain items are excluded from the scope of International Accounting Standard 32. Number one is like interest in subsidiaries. So you will be treating that interest in subsidiaries in accordance with IAS 27, and interest in associates that you will be treating under International Accounting Standard 28, and then interest in joint ventures that you will be treating under International Accounting Standard 31, and pensions and other post-employment benefits that will be treated under International Accounting Standard 19. And insurance contracts, there is a separate contract for the insurance, and then contracts for contingent consideration in a business combination. And last week we covered the consolidation. There we discussed this point. So this will not be covered under International Accounting Standard 32. Then contracts that require a payment based on climatic, geological, or other physical variables, and financial instruments, contracts, and obligation under share-based payment transactions. Under share-based payments transaction. If it is a share-based payment transaction, that falls under the ambit of International Financial Reporting Standard 2, So that financial instrument will be treated as per IFRS 2. Okay. So International Accounting Standard 32 should be applied in the presentation of all types of financial instrument, whether recognized or unrecognized, and except these these instruments which are excluded in fact. Okay. Some important terminologies. Equity instrument. We know that, like equity instrument, any contract that evidences a residual interest in the asset of an entity after deducting all of its liabilities. After deducting all of its liabilities. And then fair value, the amount for which an asset could be exchanged or liabilities settled between knowledgeable willing parties in the arm's length transaction. And then putable instruments, a financial instrument that gives the holder the right to put the instrument back to the issuer for cash or another financial asset, or is automatically put back to the issuer on occurrence of an uncertain future event or the death or retirement of the instrument holder. So the learning objective for International Accounting Standard 32 is 2. I will try, and I'm very confident, inshallah, that after we finish our discussion of International Accounting Standard 32, we should be able to differentiate between debt and equity, or we will inshallah successfully refresh your earlier concept of differentiation between debt and equity. Second, the segregation of debt and equity components of compound hybrid instrument on initial recognition. These are the two basically learning objective from our discussion of International Accounting Standard 32. Okay. Then first of all, how to differentiate between debt and equity. See, the fundamental principle is that a financial instrument should be classified as either a financial liability or an equity instrument according to the substance of the transaction, not its legal form and the definition of financial liability and equity instrument. Mean substance over form. Okay. There could be a couple of exceptions. So, but except those exceptions, you will be applying the general principle, which we shall be discussing in these slides. Financial liability is the contractual obligation to deliver cash or another financial asset. Equity is basically any contract that evidences a residual interest in the entity's assets after deducting all its liabilities. So these are the basic definition. Okay, first of all, let's discuss the examples of equity. Ordinary shares, of course, equity. These are the equity elements, instruments. See, in ordinary shares, all the payments are at the discretion of the issuer. So then preference shares required to be converted into a fixed number of ordinary shares on a fixed date or on the occurrence of an event that is certain to occur should be classified as equity. Should be classified as equity. Then next is a contract that will be settled by entity in receiving or delivering a fixed number of its own equity instrument in exchange for a fixed amount of cash or another financial asset is an equity instrument. This has been called the fixed for fixed requirement. Fixed for fixed requirement. So this means generally this fixed for fixed requirement will be applicable with a couple of exceptions. Mean you will have to apply the fixed for fixed requirement principle in order to establish whether an instrument is an equity or a liability, except a couple of exceptions. See, preference shares, like where they are required to be converted into a fixed number of shares at a fixed date, then these will be classified as equity. Note one thing here, like rights issues, when the price is denominated in a currency other than the entity's functional currency. Why? Because in this case, fixed for fixed principal requirement is not being met. So one can think that if like you are an American company, and your basically functional currency is dollar, and your subsidiary is incorporated in Pakistan, and your subsidiary's functional currency is basically rupees. And if you have announced right issue in Pakistan and people will be paying the price of those shares in the form of rupees. So there is always a risk, like due to changes in the exchange rate, the amount you will receive in the form of dollar may be different from the amount which you could have received at the date of the announcement of that right issue. So here apparently it seems that fixed for fixed requirement principle is not being met. But please note this exception: right issue can still be classified as equity when the price is denominated in a currency other than the entity's functional currency. The price of the right is denominated in currency other than the issuer's functional currency when the entity is listed in more than one jurisdiction or is required to do so by law or regulation. A fixed price in a non-functional currency would normally fail the fixed number of share for a fixed amount of cash requirement in International Accounting Standard 32 to be treated as equity instrument. As a result, it is treated as an exception in International Accounting Standard 32 and therefore treated as liability. Okay, so now comes to the debt. Debt. If there is any variability in the demand, in the amount of cash or on equity instrument that will be delivered or received, then such a contract is a financial asset or liability as applicable. For example, where a contract requires the entity to deliver as many of the entity's own equity instruments as are equal in value to a certain amount, the holder of the contract would be indifferent whether it received cash or shares to the value of that amount. Thus, this contract would be treated as debt, as a liability. If an entity issues preference shares that pay a fixed rate of dividend and that have a mandatory redemption feature at a future date, the substance is that they are contractual obligation to deliver cash and therefore should be recognized as a liability. But please note that preference shares that do not have a fixed maturity and where the issuer does not have a contractual obligation to make any payment are equity. See, even though instruments are legally termed preference shares, Mariam, I suppose you asked this question. See, why we classified two preference shares separately? Mean a preference share could be an equity instrument or it could be financial liability. See, if preference shares do not have a fixed maturity and the issuer does not have a contractual obligation to make any payment, then these preference shares are equity instruments. On the other side, if the entity issues preference shares that pay a fixed rate of dividend and that have a mandatory redemption feature at a future date, then these redeemable preference shares will be classified as a financial liability. Mariam, I hope your earlier question is answered. Okay.
One of the member, Mohammed Bakir, saying, sir,
No, just hold. Let me finish a part of yes. Okay. Okay, fine. No, just let me finish with a couple of slides to finish the discussion of the debt and the equity. Then we can take up your question. Okay. So, see, you need to consider other factors as well, like redemption option means debt. Is there a limited life to the instrument? Then is redemption triggered by a future uncertain event that is beyond the control of both the holder and issuer of the instrument? And are dividends non-discretionary? So you have to consider these factors. If any of these factors is there, so you can treat it as debt. Okay. Then the next question is, at what time we should classify an instrument as a debt or equity instrument? So please note that at the time of initial recognition, and you are not allowed to change this classification subsequently due to changes in the circumstances, whereby, for example, you have initially classified an instrument as a financial liability based on the factor we have just discussed. But subsequently, due to changes in the circumstances, you realized that no, it is an equity instrument. So you are not allowed to change this classification. So you will have to decide it at your at the initial recognition. Further, exception is, like I was discussing about the exception. The exception is basically some financial instruments that currently meet the definition of financial liability will be classified as equity because they represent the residual interest in the net assets of the entity. This exception is not related to the classification. This exception is, like I earlier mentioned, like though right issue does not fulfill the fixed for fixed requirement, even then you will be classifying the right issue as equity instrument. So this is the second exception. See, some instruments normally they meet the definition of the financial liability, but they are treated as equity instrument. Why? Because they represent the residual interest in the asset of the entity. What is the example? Example is portable financial instrument representing the residual interest in the net asset of the entity. See, instruments or components of instrument that impose on the entity an obligation to deliver another party a pro rata share of the net assets of the entity only on liquidation. So these are termed as portable financial instrument. Putable financial instruments are classified as equity instrument, though they apparently meet the definition of the debt instrument. Though they apparently meet the definition of the debt instrument. Okay, before moving to another learning objective, so I can answer your question. So, Mr. Khayyam, would you please help me in
Yes. Mohammed Baqi saying, so what about shareholders, director fund? What should be the treatment for the same? Will it be equity?
Sorry again.
What about the shareholder oblique director fund? What should be the treatment for the same? Will it be equity?
Shareholders, so please can you clarify your question, because director fund, what do you mean by director fund? Are there any shares involved in it, or is there any options or things like this? If you are talking about director share option schemes, of course, if those are equity settled, then these are basically equity instruments. But I mean, that fulfills the definition of the equity instrument. But as we have seen in the scope exclusion, that these will be treated, these are equity instruments, but these will be treated in accordance with International Financial Reporting Standard 2. I hope this was your question.
So how to account for convertible financial instruments attached with uncertain conditions? How to account for if other way around takes place, which we initially recognized Usman Yusuf.
Usman Yusuf, you are talking about convertible instrument. So we are about to start discussion on convertible instrument in a while. Next question.
Okay, Sadia Aslam saying an example of such an exception for financial instrument which meets the definition of financial liability but is in fact an equity.
Sadia, example is putable financial instrument. You can note it, putable, P-U-T-T-A-B-L-E, putable financial instrument. See, an entity shall classify a financial instrument as an equity instrument from the date when the instrument has all the features and meets the conditions set out in the standard. So, answer of your question is putable financial instrument. In fact, putable financial instrument represent the residual interest in the assets of the company, and it imposes, these instruments impose on the entity an obligation to deliver to another party a pro rata share of the net assets of the entity only on liquidation. I hope it is clear. Next.
Okay, we have another question from Usman Yusuf. If any arrangement is made which does not require investment in shares or equity instrument but gives residual interest in the assets of the company, then it will be classified as equity?
Yes, of course. It will be classified. Anything which provides you a residual interest in the company.
Sadia saying thanks, and Burhanuddin.
Sadia, you are welcome. Burhan, yes.
Burhanuddin saying if an entity enters into a contract to sell goods to another party on credit, it will give rise to trade receivables for one party and trade payables for another party. We account for this contract in accordance with IFRS 15. What is the difference between this contract in terms of IFRS 15 and IS 32?
See, Burhanuddin, so far as the recognition of the amount is concerned, and so far as like you need to decide, should you recognize revenue related to those goods? Is there a contract? All these questions will be answered under IFRS 15. But once you made an entry like debtors debit, and revenue credit. Thereafter, these debtors will become your financial asset and will be treated in accordance with IFRS 9. But to the point you made this entry, like debtor debit, revenue credit, you will be applying IFRS 15. Once you made this entry, subsequently, these debtors will be treated in accordance with IFRS 9. Burhanuddin, I hope it's clear.
No more questions are there.
Okay, fine. We can move to the next question.
Saying yes, thank you.
Welcome.
Saying please give example of equity instrument other than investment in shares.
In shares, Usman, see, there could be such instruments like A category shares, B category shares, like those shares, those shareholders who cannot like participate in the decision making process, other categories of shares which are not whose holder cannot participate in the decision making process, mean there are other classification of shares which are equity in fact, because their return is the dividend and the residual interest in the asset of the company. Otherwise, they are not involved in the decision making and they do not have some other rights as well. So these are basically the instrument which are basically equity instrument. Okay. Now let's move further. The second learning objective of International Accounting Standard 32. See, if an organization issues a hybrid instrument, like someone gave the example of convertible, their International Accounting Standard 32 requires, I'm sure we are all clear about hybrid or hybrid instrument. Hybrid instrument is in fact is an instrument which provides you the holder an option to receive cash or the equity shares of the issuing entity. There is an option, like either you can go for cash or you can go for shares. So such instrument is termed as hybrid instrument, with two options. So International Accounting Standard 32 requires that hybrid instrument should be recorded by separating the debt and equity element. First of all, debt element is calculated and the equity portion is residual value. For example, if company received cash rupees 3,000 on issuance of a convertible instrument, and the company calculated debt element as 2,500 rupees, then the equity element will be the residual amount, which is 500 rupees. I repeat it again. My example was, if a company issue an instrument and receive rupees 3,000 cash, in order to initially recognize this instrument, the entity measures the debt element as 2,500 rupees. So the remaining amount, the difference of 3,000 and the debt element of 2,500 will become the equity element. And we know the entry for this will be very simple. The entry will be like debit. Entry will be debit cash, and credit 2,500 to equity, 2,500 to debt and 500 to liability. This will be the simple entry for this transaction. Okay. Okay, what are the simple steps for segregation of debt and like equity? First is calculate future cash flows attached to that hybrid or compound instrument, assuming that cash will be paid on redemption. Assuming that cash will be paid on redemption. This is step number one. Actual cash flows. Then is step number two. Before moving to step number two, we can apply step number one on this small example. If an entity issues 3,006% convertible debenture of rupees 1,000 each at par for a period of 3 years, which will be redeemed either at par or 250 shares against each convertible debentures, the market rate or effective rate of interest is 9%. What are the future cash flows attached to convertible debenture? So please do the calculation, and we can make it as a pop-up question. I can give you a couple of options to choose from, to opt from. What are the future cash flows, either in the form of interest or capital repayment at the end of the instrument period, instrument term? We shall be popping up a question. Can I make you write that question?
Just give me a moment because I'm going to that very minute. Yes. What question do you want me to write down? Question statement.
Yes. What are the future cash flows attached to the convertible debenture?
What are the future cash flows attached to the convertible debentures?
Convertible debentures.
Debentures. Okay.
Okay. Option one.
Yes.
Interest payment.
Interest payment.
270,000. 27 tetrazine.
Okay.
And in the same option.
And
Principal 3 million.
3 million.
Option 2.
Okay.
Interest payment 180,000 per year.
Okay.
And 3 million principal. So these are the two options. So just answer the correct option. I suppose you people have downloaded the slides. So when the question is popped up, you can look at those slides on slide number 23.
Okay. When the pop-up question is on the screen, you guys cannot see the presentation. So in the meantime, you have to participate in the poll question. The presentation will come back again once the poll question is closed. Thank you.
But because I suppose you have downloaded that presentation, so you can go to slide number 23 to just re-look at that example before answering this poll question.
So far, only 9% people.
No. Please come up. Please come up. because this is important, subject.
All the handouts are also available at Google Doc link, so all the attendees can download it from the Google Doc link that we have provided them already.
So it is better we should keep quiet for a while so that they could think out their answers. Okay, 30 seconds are left.
So far, 16% people have participated in the poll. Only 20 seconds left now. I'm going to close the poll question in a bit, so you have to submit your answers right away. Please come up with your answers and submit it. Now only 10 seconds left. Okay, so I'm going to close this poll now. Okay, I have closed the poll, and we have 53% people saying payment of interest 2,70,000 per year and principal 3 million, while 47% people saying interest payment of 1,80,000 per year and principal amount 3 million.
47% are correct. See, example is in front of you. Your cash payment is always based on the nominal interest rate, the coupon interest rate, which is 6%. Cash is always paid on this coupon rate of interest or nominal rate of interest. So far as the market rate of interest is concerned or the effective rate of interest is concerned, this is not the basis for the payment of the cash. In fact, if I have issued bonds, at the time of issuance, if I mentioned in the bond document that we shall be paying like 6% of face value, like here in this case, like 3 million. So subsequently, whatever is the market rate, whatever is the effective interest rate, that has nothing to do so far as the calculation of the cash payment interest payment is concerned. So this means 47% are correct. Okay, this was step number 1. Okay, now move to step number 2. Step number 2 is basically discount future cash flows using market rate or effective rate of interest. So this is basically the utilization of the market or effective rate of interest. So this will be used for the calculation of the present value of future cash flows, which we determined under step number 1. So here what we did, so this was step number. So what we can do here, like we can see that if I use an empty page, okay, so this is the page available. See, here we can see that if we mention over here like year, cash flows, cash flows. Okay, let me come down here. Cash flows, and then discount factor, and then the present value. Present value. Present value. See, at the end of year 1, then at the end of year 2, then at the end of year 3, what will be the cash for us? This is a debt instrument. So see, for us, at the end of first year there will be an outflow of 180,000, means 6% into 3 million. This will give us the interest payment. So this is outflow in first year, and the same will be the outflow in second year, and in third year. Of course, we shall be repaying. We are assuming here, as I mentioned in step number 1, as if this instrument will be settled in cash. So if this will be settled in cash, then at the end of third year, your cash outflow will be this amount. So discount factor, always remember, we shall be discounting these cash flows using effective interest rate or market rate of interest. So which is given, which is here 9%. So when we apply this discount factor, so this will give us some value over here, and when we total it, so this will give us 272183. So this is basically the debt element. Debt element within this hybrid instrument. This is the debt element. Okay, if we move further, equity element will be equal to equity element will be equal to equity element will be equal to, in fact, equity, let me move to the next page. Okay, fine. So equity element equity is equal to the 3 million which we received in the form of cash minus this debt element as we calculated. So this means equity element is 227817. So our journal entry for recording this compound and instrument will be like we have received cash or when, preferably account 3 million, then credit debt account or liability, financial liability, you can term it as a financial liability, 20772 183, and credit equity reserve. So this will give us 227817. This is the double entry for initial recognition of hybrid instrument. So this was the step number 2, and then then we discussed the double entry as well. See, this is a small illustration. So we shall be using this small illustration because it involves only 2 years. So you can perform calculations very quickly. For 2 pop-up questions. One pop-up question will be for step number 1, and another pop-up question will be for step number 2. Those members or those participants who have not yet downloaded the handouts from GoToWebinar, please do that, because when pop-up question will appear, you cannot see this slide. So having this slide in front of you is sometime important to answer your pop-up question. Like Graham Ghosh issues a 3% $200,000 2-year convertible bond at par. The effective rate of interest of the instrument is 8%. The terms of the convertible bond is that the holder of the bond on the redemption date has the option to convert the bond to equity shares at the rate of 10 shares with a nominal value of $1 per $100 debt rather than being repaid in cash. First requirement is what are the future cash flows? Mr. Hayam, can you please write it down?
Yes.
What are the future cash flows?
What are the future cash flows?
Cash flows attached to convertible debentures. To convertible debentures. What are the future cash flows attached to convertible debentures? Okay.
Yes.
Option 1. Option 1 is 6,000 interest per year and 200,000 capital repayment. Capital repayment. Option 2. 16,000 16,000 interest payment and 200,000 capital repayment. Capital repayment. Please pop it up.
The question has been popped up. All attendees should participate.
Please participate in this small question because earlier we got very discouraging response, like only 47% participants were correct. This should not happen because this is a very basic concept, and this basic concept has not changed maybe from last 2 decades, because there are many changes in the financial instruments, but so far as this concept is concerned, this is the same for last more than 20 years.
So far, 12% people have voted. I think the person have already been with the participants.
30 seconds are left.
15 seconds left now, so those participants or attendees who are working on it, please submit their question, please submit their answer right away, as I am going to close it in a bit. Only 5 seconds now. Please come up with your answers. Okay, so I am going to close this one. 70% people saying 6,000 interest payment and 200,000 capital repayment, while 30% people saying 16,000 interest payment per year and 200,000 capital repayment.
Okay, 70% are correct. So at least the figure moved from 47% to 70%. I'm happy. But the rest of the 30% should also come with the right answer. See, I again repeat. See, what is the confusion? The confusion is, should we apply that 3% or 8% to the face value of this debt for the determination of the interest payment? So far as the capital repayment is concerned, that is the same in both options. So this was in fact like a point that need to be decided. See, remember, actual interest payment will always be made on the coupon rate or the nominal rate, which is 3%. Actual cash payment will always be made on the coupon rate of interest or the nominal rate of interest, which is in this case 3%. When you apply this 3% to 200,000, which is the face value of your instrument, this will give you the actual cash outflow related to the interest payment. So 70% people are correct. Okay. Step number 2 is, what we will do, we will simply apply the effective interest rate. We will apply the effective interest rate. Here in this case, see, there are only 2 years. Year 1, year 2. Cash outflows are 6,000, year 1, and in year 2, 6,000 plus 200,000, mean principal repayment as well. So these are our cash outflows, and discount factor will always be based on effective or market interest rate, which is 8% in this case. So this is for year 1, this factor, and for year 2, or you can see the present value table as well. So this will give us some figure here, some figure here. When we add up these two, this will give us 182, 167. So this is basically debt element. This is basically debt element, and equity element will be the amount received minus debt element. This will give us 200,000 minus 182,167. This will give us 17,833. So the double entry will be debit, say cash or bank, 200,000, and credit debt element, financial liability, which is 182,167, and credit equity element with the amount calculated 17833. So this is the double entry. Okay. Now let's move treasury shares. Treasury shares. This is a small concept. Treasury shares, if an entity reacquires its own equity instruments, those shares are normally termed as treasury shares and shall be deducted from equity. No gain or loss shall be recognized in profit or loss on the purchase, sale, issue, or cancellation of an entity's own equity instrument. Consideration paid or received shall be recognized directly in equity. Then disclosures. See, disclosures related to financial instruments will be covered in International Financial Reporting Standard 7. There are no disclosures in International Accounting Standard 32. The disclosure related to treasury shares are in International Accounting Standard 1, presentation of financial statement, and International Accounting Standard 24, related parties for share purchases from related parties. So this was all about International Accounting Standard 32. We shall be having a short break, and once we resume after break, we will be ready to take your question related to International Accounting Standard 32 before moving to the other standard. Thank you. Okay, questions are, Khayyam, can you please read this question one by one?
Okay, let me check with them.
If we have the rest, we can. Okay, so let me.
Adil Niaz saying, I could not listen, there is no sound, but Adil, we were on break. Usman Yusuf, circumstances in which entity purchases its own shares. Please give example. Mohammed Ahmed,
I just
again, no sound. For people saying no sound, we were on break.
See, Usman, sometime you can utilize your excessive cash for buying back your own shares to improve the earning per share and like this. So this is an example. Usage of excess cash. Next, okay. So okay, now the next next standard. And that is International Financial Reporting Standard 9, Financial Instruments. See, before going into the details, let's have a look at important terminologies, which will keep on coming back in this standard. Number one is amortized cost. See, amortized cost of a financial asset or a financial liability is the amount at which the financial asset or liability is measured at initial recognition, minus principal repayments, plus or minus the cumulative amortization of any difference between the initial amount and the maturity amount, and minus any write-downs for impairment or uncollectibility. See, this is the definition of the amortized cost. Then the next definition is effective interest method. See, the effective interest method is a method of calculating the amortized cost of a financial instrument and of allocating the interest income or interest expense over the relevant period. The effective interest rate is the rate that exactly discounts estimated future cash payments or receipts through the expected life of the financial instrument to the net carrying amount of the financial asset or liability. So this is the effective interest rate. Is the rate that exactly discounts estimated future cash payments or receipts through the expected life of the financial instrument to the net carrying amount of the financial asset or liability. Okay, these were the important terminology. If need be, we can relook at these important terminologies. See, under IFRS 9, we shall be discussing accounting treatment of equity instruments, accounting treatment of financial liabilities, accounting treatment of financial assets. Thereafter, of course, we shall be discussing impairment concept and hedging. So these will also be discussed. See, first of all, let's start with a very simple concept, equity instruments. See, equity instruments are initially measured at fair value, less any issue cost. In many legal jurisdictions, when equity shares are issued, they are recorded at a nominal value, with the excess consideration received recorded in a share premium account, and the issue cost being written off against the share premium. Subsequently, the equity instruments are not revalued. Okay, so this is a simple treatment for the equity instrument. Only initially you will have to apply the fair value less any issue cost, and subsequently you will not remeasure equity instruments. So let's look at financial liabilities. See, financial liabilities. There are two measurements: subsequent measurement for financial liability and initial measurement. Subsequent measurement, your policy about subsequent measurement, mean your initial measurement will depend on how are you going to measure that financial liability subsequently. So that's why I have mentioned subsequent measurement at the start of this slide. In fact, practically you will be measuring your financial liability initially, and subsequently you will be applying the material which is appearing at the start of the slide. See, initial measurement, fair value, if subsequently it will be measured at fair value through profit or loss. And fair value less issue cost if it will be subsequently measured at amortized cost. There is a small difference of issue cost. If that financial liability will be subsequently measured at amortized cost, then you will reduce the fair value by issue cost. You will reduce the fair value by issue cost. But if subsequently you will be measuring the financial liability at fair value through profit or loss, then initially that financial liability will be measured at fair value. Now come to the initial measurement. Is it automatic or is there any rule? See, the rule is if there are certain conditions, then you will measure financial liability at fair value through profit or loss. But if none of the conditions is there, then you will be measuring that financial liability at amortized cost. So this means you just need to memorize what should be there in order to measure the financial liability at fair value through profit or loss. If those conditions are not there, this means that financial liability will be measured at amortized cost. See, if it is held for trading, then that financial liability will be subsequently measured at fair value through profit or loss. Or upon initial recognition, the financial liability is designated at fair value through profit or loss. This is permitted when it results in more relevant information because it eliminates or significantly reduces a measurement or recognition inconsistency, accounting mismatch. Okay, let me repeat it. 2, if it is held for trading, that financial liability will be measured at fair value through profit or loss. Or at initial recognition, you designated that this will be subsequently measured at fair value through profit or loss because otherwise this will result in accounting mismatch. And then all derivatives are always measured at fair value through profit or loss. If we just ignore the discussion of derivatives, non-derivatives financial instrument, all other non-derivative financial instrument, you will measure them at amortized cost. And for derivatives, those will always be measured at fair value through profit and loss. Okay, now what we concluded here, very simple. Very simple. We concluded like if this is for, this treatment is for held for trading financial liabilities, number one, or number two, this treatment will result in more information. For example, will avoid accounting mismatch. Accounting mismatch. So this means except these two, all other amortized cost, all other amortized costs. Just remember this for financial liability. This means you just need to remember these two things. If none of these is there, then this should be your measurement basis, amortized cost. So this is the default position, in fact. This is the default position. So this is the way you will be deciding about the measurement policy. Okay. Now let's discuss about the accounting mismatch. What is this? What is the accounting mismatch, in fact? See, the accounting mismatch is, in fact, okay, if an entity holds a financial asset that is debt and that carries a fixed rate of interest, that is debt that carries a fixed rate of interest, but is then hedged with an interest rate swap that swaps the fixed rates for floating rates. See, the interest rate swap is a financial instrument that would be held at fair value through profit or loss. And so accordingly, the financial asset classified as debt also needs to be at fair value through profit or loss to ensure that the gains and the losses arising from both instruments are naturally paired in income and thus reflect the substance of the hedge. This means if you have a financial liability, at fixed rate of interest, but subsequently you hedged it with an interest rate swap that swaps the fixed rate for floating rate. The interest rate swap is a financial instrument that would be held at fair value through profit or loss. And so accordingly, the financial liability classified financial liability needs to be at fair value through profit or loss to ensure that the gains and losses arising from financial liability and interest rate swap are naturally paired in income, and thus reflects the substance of the hedge. But if you subsequently measure your financial liability at amortized cost, but the interest rate swap is being measured, of course that will be measured at fair value through profit or loss. So this will result in an accounting mismatch. In order to avoid this accounting mismatch, it is recommended you will be measuring both the hedged item and the hedging instrument at fair value through profit or loss. So this is the point number 2.
Sir, we have some questions.
Yes, please.
Sarah Thomas asking, please give an example for financial liabilities held for trading.
Financial liabilities held for tradings. Sarah, right now I cannot recall any example, but subsequently, if it comes to my mind, of course, definitely I'll be sharing with you. Next.
Okay, Muhammad Salman Yusuf. Can you kindly give an example of accounting mismatch?
Muhammad Salman, I explained it in very detail. I suppose your question is before this explanation.
Yes, around 5.
Okay, then next question. I hope your question is already answered.
All questions have been answered.
Okay. Then let's move further. Okay, illustration number 1, amortized cost. This is the illustration. A company raises finance by issuing 20,000 6% 4-year loan notes on the first day of the current accounting period. The loan notes are issued at a discount of 10% and will be redeemed after 4 years at a premium of $1,015. The effective rate of interest is 12%. The issue costs were $1,000. Explain and illustrate how the loan is accounted for in the financial statements of the company. So this is the requirement. Here we can see that. Like this will subsequently be measured at amortized cost. This will be subsequently measured at amortized cost. So what are the other facts? Other facts are like see, this is the 20,000. This is the face value. But because you have issued these bonds at discount, this means 10% discount mean, in fact, you received 18,000 in cash. This is the receipt. And then there is an issue cost, which is 1,000. Which is 1,000. 1,000. See, we know from our earlier slide, the financial liability which will subsequently be measured at amortized cost, the initial measurement will be the net of these two figures. So this means this financial liability will initially be measured at 17,000. This is the fair value. In fact, cash received is the fair value. This is the fair value which we in fact received, and less 1,000. If we were required to measure this financial liability subsequently at fair value through profit or loss, then on initial measurement, we would not have reduced this 18,000 by this 1,000. We know this from earlier slide. Okay, this is the 17,000, which will be uh, used for subsequent calculation. Okay. For like if we just see what will happen subsequently. Okay, we know for sure 17,000. 17,000 will be the amount on initial recognition. So we can use an empty like document to illustrate this concept. We can come over here. See, this means year 1, years, like it has got 4-year life, 1, 2, 3, 4. So the opening balance, OB being opening balance, we know we recognized it at 17,000 after reducing it by the issue cost. Then profit and loss charge, mean finance charge. This charge will always be calculated at the effective rate of interest or the market rate of interest, less cash paid. And we know from our discussion on International Accounting Standard 32, cash will always be paid using the coupon rate of interest, which is in this case 60%, to the face value. Face value is 20,000. So this way we shall be calculating the cash paid. So here in this case, this will give us 1,200. This is the amount of cash which we have paid, and effective interest rate as given in the question is 12%. When we will apply 12% to the amount, so this will give us 12%. So this will give us 2040. But here important point is, like for this calculation, if I highlight it over here, this is basically effective rate of interest into opening balance. Whereas for 1,200, this is the calculation for 1,200. Simply multiply the coupon rate of interest with the face value. These are the small points which make big difference in your calculation. If you correctly memorize these small concepts, so you can correctly apply to your practical situations. So then we will reach the closing balance. So closing balance will be very simple. Add these two, and then minus this. So this will give us 17,840. This will be your liability bifurcated into current and long-term portion. This will be appearing in your statement of financial position. This will be appearing in your statement of financial position. So this will become the opening balance of second year. Again, we shall be applying on this opening balance effective interest rate. This will give us 2141, and this is the 1,200. This will give us 18,781. Then 18,781. Again, the same principle which we discussed earlier, and this will give us 19,835. Likewise, 19,835 will become opening balance, and this is the calculation of the effective interest rate. And here the amount paid is in fact 1,200 plus 21015. If you just look at the information of the question, you will find that this is basically because we committed with them that we shall be like paying them the principal plus a premium of 1015. I suppose this is the figure given over there, and at the end you will have no liability. So these amounts will be charged to the profit and loss account. These are basically profit and loss account charge related to this financial liability. Whereas this is the statement of financial position, as I mentioned over here. This is basically the statement of financial position at the end of year 1, statement of financial position, financial liability, year 2, year 3, year 4. But of course, this will be bifurcated into current and long-term portion. This will be bifurcated into current and long-term portion, and wherever these two portions are there, but at the end of third year, of course, only one portion will be there, which is the current portion, long-term, because this whole amount will be paid within a period of 12 months. Okay, this is the illustration of amortized cost. Okay, now come back to our slides. Next is the illustration of fair value through profit or loss. See, the illustration is on 1st January 2011, A Limited issued 3-year 5% 30,000 loan notes. It should be in front of me as well. Okay. Loan notes at nominal value when the effective rate of interest is also 5%. The loan notes will be redeemed at par. The liability is classified at fair value through profit or loss. At the end of the first accounting period, market interest rates have risen to 6%. 6% required. Explain and illustrate how the loan is accounted for in the financial statement of A Limited in the year ended 31st December 2011. Before going into the discussion, we can have a look at some of the information given in the question. See, here you can see that 30,000 is received. 30,000 is received. And this is the face value as well. And what is the coupon rate of interest? Coupon rate of interest is, coupon rate is 5% given. 5%. Mean if I want to calculate the actual cash outflows, I will be applying this 5% to this 30,000. Whereas question says 5% is also effective rate of interest. So coupon rate of interest is 5% and effective rate of interest is also 5%. So because this financial, there is no issue cost, I don't see any issue cost in the question. Had it been there, we would have ignored it, because this is the financial liability which will be subsequently measured at fair value through profit or loss, and we know that for such liability, you should initially measure it at fair value only, and the fair value here is 30,000. So this means this financial liability will initially be measured at 30,000. This will be initially measured at 30,000. Now what happened? The same way, this will become our opening balance. If we just go back to Word doc, we just go back to Word doc. See here in this case, let me go to a fresh page so that I could have space over here. See again here it will become opening balance. Year. Say here we have how many years we have here. Here we have, I suppose, okay, we are required to perform the calculation only for the first year. That will be enough to explain this concept, to differentiate it from those financial liability which are subsequently measured at amortized cost. Okay, so year is 2011, and on 1st January 2011 being opening balance, as we have just discussed, this will become 30,000. Then is the finance charge. Finance charge. How we will calculate it? Of course, opening balance into effective interest rate. So we shall be multiplying 5% because effective interest rate is also 5%. So 5% will be multiplied to the 30,000. So this will give us a figure of 1,500. So this is the finance charge. Then cash paid. We know that this cash paid will be on the face value, which is 30,000, into coupon rate of interest or nominal rate of interest, coupon rate, which is again 5%. So this will again give us 1,500. So liability will become, closing liability will become 30,000. At this point in time, we can see from our question information, like there is a change in the effective interest rate, which is now 6%. There is a change in the effective interest rate, which is now 6%. So at this point in time, mean on 31st December 2011, you will calculate the fair value of this financial liability using 6% as a discount rate. Using 6% as a discount rate. The method is very simple. Just determine what are the actual cash flows subsequent to 31st December 2011. And because its total life is 3 years. I suppose it is 3 years. Let me check. Is it 3 years or something else? Yes, I suppose it is 3 years. Okay, 3 years. So this means only 2 years are left. Mean 2012 and 2013. 2 years are left. And simply we need to see, okay, this means what will be the cash flows? Cash flows, actual cash flows in 2012, at the end of 2012, mean 31st December 2012, 1,500, And then on 31st December, the last year of this of its life, 1500 plus the capital repayment, which is 30,000. Multiply these two figures with the revised discount rate, effective rate, which is 6%. So for this year, the discount factor will be this. And for this year, the discount factor will be 1.06 raised to power 2. So this will give us 1415. And this will give us 28035. So in total, 29450. So this is the fair value of this liability as at 31st December 2011. See, the concept is very simple. You want to determine the fair value at 31st December 2011. Simply from that date onward, in second year and third year. But for from the point of view of 31st December 2011, 2012 is now first year, and 2013 is now second year. And in second year, 1500 plus capital repayment. And now, so these are the cash outflows, actual cash outflows subsequent to 31st December 2011. Then discount these actual cash outflows by using the revised effective interest rate, market interest rate, which is now 6%, So this will give you the fair value of this liability at 31st December 2011. Please note this figure, because when I write something on slide, this will be saved in recording. But when I will move to my Word document, so the system will raise this information. So what is the fair value of this liability? 29,450. Now what I will do next? What I will do, I will see what is the difference See, this was your liability, but we have calculated 29,450. This is the fair value. Now the difference between these two will be sent to the profit or loss.
550.
Sorry?
550.
550. Okay, thank you very much. This will be taken to the profit or loss. And this green amount will appear in statement of financial position. Of course, bifurcated into current and long-term portion. Likewise, every year, now from next onward, this calculation will be based on 6%, the revised effective interest rate. And likewise, you will continue And whenever there is a change in the effective interest rate, you will uh, do the calculation as we did for the determination of the fair value of your financial liability. If we have any question related to this calculation, so we can answer them now.
No, not to this question, but some questions are there. Can you kindly share the answers to the calculations asked by Param Rashid? And shouldn't the premium be considered in calculating fair value, Mirza Bey?
Mirza Bey, if we just look back, we have done that. See, in the last year, see here, if we just go back to the calculation where premium was involved, here you can see that we have taken here 21,015, and this 21,000 is after the incorporation of the premium. Mirza, I hope it is clear.
Burhanuddin, if an entity maintains a policy of provision for doubtful debt for the total trade receivables, then this connects with IS 37. And similarly, irrecoverable debt will lead to de-designation as per IFRS 15 in the context of subsequent measurement. What is the main objective or contribution of IS 32 or IFRS 9 in connection with the treatment or measurement of trade receivables or trade payables?
Burhanuddin, what I gathered from your question, you mentioned that perhaps allowance for or provision for doubtful debt is treated under IC 37. This is not the case. Though we use the word provision, but this word is not appropriate. That's why you related it to International Accounting Standard 37. In fact, the word should be allowance for doubtful debt. This is purely an impairment of your debt, and that is dealt under IFRS 9, and we shall be discussing it under impairment of your debtors. So that is not that will not be dealt with under International Accounting Standard 37. So please make it clear. So I hope I answered your question, Burhanuddin.
No.
Okay. Okay. Next is this was basically the fair value. Now, next concept is the de-recognition of financial liabilities. We discussed the recognition of financial liabilities. So let's discuss the de-recognition of financial liability. This is very important concept, and we shall be discussing this concept with the help of course, a practical illustration. See, a financial liability is de-recognized when it is extinguished, that is, when the obligation specified in the contract is discharged or cancelled or expires. So here we have the guideline. Rather, I would make it 2 for more clarification. See, this is not the third point, in fact. This is basically, in total, there are 2 points, in fact. And these are these 2 write-ups related to these 2 points. Okay. See, de-recognition. Number 1, where an existing borrower and lender of debt instruments exchange on financial instrument for another with substantially different terms. This is accounted for as an extinguishment of the original financial liability and the recognition of a new financial liability. Mean your financier has replaced your existing debt with a new debt with a substantially different terms. interest rate, like terms of the loan, and then premium or discount or whatever other terms that are substantially different. So you should de-recognize your existing liability, and you will recognize the new liability, where this is the case. This pen here, so this will give us some. Okay, pen we can use from here. Substantially different terms. Mr. Hayam, can we move this place of
Yes, we can
like the screen, because this is causing problem
from mouse. Please give me the mouse.
Okay, actually mouse will become your.
Just give me the mouse.
Okay. No, move it to the upper left. Move it to the upper left. Okay, okay, fine. Now it is fine. So now I'll have to select the pen again.
Yes.
Okay, so fine. Thank you. See, substantially different terms. Very simple. So this means you will de-recognize your existing liability. Okay, now move to number 2, which is a little more technical. A substantial modification of the terms of an existing financial liability or a part of it should be accounted for as an extinguishment of the original financial liability and recognition of a new financial liability if there is a modification of the terms. Now, what is the modification? When that modification will be substantial. When that modification will be substantial. Here is a criteria. Here is a criteria. You can see that when the present value of cash flows, using original effective interest rate and present value of cash flows using effective interest rate at the date of inception. Mean you will be calculating your financial liability, cash flows related to financial liabilities by applying 2 different discount factors. The original effective interest rate, if there is a difference of 10% between these 2 amounts, then this will be taken as if it is a substantial modification. If it is a substantial modification. Okay, let's understand with the help of an illustration. So it is better that we should use some empty document, because a lot of mess is created on that and it is restrictive as well. Then next is the accounting treatment of this. The difference between the carrying amount of financial liability and the new liability will be recognized in profit and loss. Okay, you people have this illustration which I am going to discuss now. Okay, we have here illustration. I suppose this is the folder. Yes, this is the illustration. See, during 2000, let me make it a little large. Yes. During the year ended December 31st, 2008, a Pakistani sugar company, PSC, was facing severe problems in meeting its obligations. In October 2008, PSC commenced negotiations with the lender for restructuring of loan. Following is a summary of the liabilities of the company as of December 31st, 2008, prior to making adjustments on restructuring. Loan amount 28 million. So let me keep it in front of me as well. Okay. So 28 million. This is the carrying amount. Okay, where is the length of pen? Where is the length? Here it is. So this is the carrying value of our financial liability. Carrying amount. Okay. The loans are repayable. Okay, what are the other facts? The other facts are, yes, these are here. In October 2008, PSC commenced negotiation with the lender for restructuring of loan. Following is a summary of the liabilities of the company as of December 31st, 2008, prior to making adjustments on restructuring of loan. So this is the carrying value of that loan. Okay, remaining number of installment including interest rate markup, okay, 2.5. The loans are repayable. The loans are repayable in equal annual installment. Agreement with SBD was finalized and signed before the year end. Following is the information in respect of rescheduling agreement. This is the revised value of loan. Revised value of loan. This is the revised value of loan. And this is revised present value as per the original effective interest rate. And this is the revised present value as per the market interest rate. Okay. So now, as a result of this restructuring, we will be comparing the carrying value of the liability. What was that? As we seen at the start of the question, carrying value of liability was 28 million. This was the carrying value. I mean, this is the amount appearing in our account before the incorporation of the effect of any restructuring. Now, when we restructured this loan, so what is the revised value? This is the revised value. Revised present value as per the original effective interest rate. Now we shall be calculating the difference between these two figures, this figure and this figure. The difference is, Hayam, can you 312 minus 28. The difference is basically 3.2 million. This is the difference. So this difference is in fact 11.43%. Difference between the carried amount immediately before the incorporation of the restructuring effect and the revised present value as per the original effective interest rate. If this difference is more than 10%, so this restructuring will be treated as this is a substantial modification of the loan. In this case, you will de-recognize it and you will recognize this loan, which is a fair value. The difference between these two, so far as this figure is concerned, this is only for the purpose of calculation of the difference to see whether it is more than 10% or not. If it is less than 10%, then the existing liability will not be extinguished. But now, because this difference is more than 10%, this existing liability will be extinguished. Extinguished means we shall be de-recognizing it, and the entry will be debit old loan from SBD account 28 million and credit new loan from SBD, and this is new loan account at fair value, of course. Don't confuse it with that 31 point something million, because whenever you initially recognize your financial liability, we learned during this session that will be recognized at fair value. So this is the fair value. The difference will be debited to the profit or loss. This is the difference between these two amounts. So this is all about financial liability, and starting from initial measurement and then subsequent measurement, and then rules so far as the de-recognition of financial liability is concerned. We shall be having a short break, and then we shall be resuming from the same point. Okay. Okay. So if you people have any question, please ask now, and we can move to our next presentation. Okay. Can you just see if we have any question? Because we have finished with a substantial area.
How this 11.43 question comes, please explain, because I could not hear.
Can you please sit if we have any other questions, because we are left with few minutes in which if you people have any question, please ask it now, so that before moving to the next area we should be very clear. Okay, the question is like how we have calculated. See, the difference between these two is 3.2. So this is the carrying amount. So we have calculated 11.5%, 31 point minus 28 million divided by 28 million into 100%. I suppose I mentioned the correct number of zeros, but it should be 6. This should be 6. In fact, 28 million. It should be 7. Okay. What should I do? I should use the razor, but I'm afraid that this will take us. Okay. So 28 million into 100%. This will give us 11.43%. Is it clear? Can you please check if it's clear or not?
Yes, this is around 11.428%.
Okay, I mean this is clear.
Yes, this is correct.
Okay. Okay, should I move? Okay, fine. See, we discussed International Accounting Standard 32. I deliberately postponed one concept in the compound instrument which you normally face practically, and that is related to the issue cost. What we learned that a compound instrument is subdivided into the debt element and the equity element. And the illustrations which we used to explain this concept, no issue cost was involved. Now, what happened if issue cost is involved? Because when you bifurcate your compound instrument into the debt element and the equity element, and that debt element is in fact your financial liability. And if that financial liability is subsequently being measured at amortized cost, which is normally the case, what about the issue cost? Because that issue cost is not only related to the debt element, but also it relates to the equity element as well. So what will be the treatment subsequently of this issue cost, and how it will affect the measurement at initial recognition? So this is our small discussion related to this area, in fact. Okay. So we can use an example to discuss this point. of issue cost. So I can use the space over here. Okay. See, suppose on 1st July 2011, 1st July 2011, 2 million convertible debentures. See, I should mention this information over here. 1st July 2000, 1st July 2011. 2 million convertible debentures of 100 each were issued. 2 million 100 mean, in fact, in total we collected 200 million. Okay, each debenture is convertible into 25 ordinary shares. How many debentures? 2 million debentures. And rupees 100 is the face value of each debenture. So this is the basic information. And each debenture of 100 can be converted into like 25 shares, or you can receive cash of rupees. I suppose I am assuming here there is no discount or premium, rupees 100. So this is the conversion. Now what happened? Interest is payable annually in arrears at the rate of 8%. So this means coupon rate of interest is 8%. This is the coupon rate of interest. Okay. On the date of issue, market interest rate for similar debt without conversion option was 11%. So this is the coupon rate of interest. And we know that this rate will be used for the calculation of actual cash flows, coupon rate of interest. And on the same date, effective interest rate is effective interest rate is 11%. Okay. Issue cost incurred was 4 million. 4 million. And this increased the effective interest rate to 11.81%. Now, the question is, how can we treat this 4 million on initial measurement, and if it has got any effect on subsequent measurement? Okay. Let's solve this small example. This will give us an idea how can we deal with this issue cost. Okay, it should be in front of me as well. Like the question was, in fact, convertible debentures, 2 million convertible debentures. 2 million convertible debentures. Yes, it is in front of me. Okay. So, how much cash you received? The cash received is, in fact, 196 million, because this is the face value and you paid 4 million out of this, and you received, in fact, 196 million. So this means cash or bank will be debited with the 196 million. So how can we calculate the present value of the liability? The present value of the liability. So this is important. How can we incorporate this issue cost? See, if for a moment we forget about that there is an issue cost. Okay, if there is no issue cost, I suppose this illustration is very clear. If there is no issue cost, first of all, calculate the present value of the debt element, assuming that there is no issue cost. And then the difference of 200 million and the debt element will become your equity element. Now, these are the debt and the equity element without issue cost. Now, prorate your issue cost of 4 million among the debt element and the equity element based on their value determined ignoring the issue cost. Now, whatever portion you have allocated out of 4 million to the debt element and the equity element, reduce the debt and the equity element with that allocation. This will give you the debt element and the equity element for initial measurement and for passing the journal entries in case of issue cost. So, because we do not have time now, I will try to solve this small illustration for you and to explain it, what I said theoretically, how can we apply that on these figures and what will be the end result at the start of tomorrow session. Thank you very much. If you have any question, you can ask it now.
In the meantime, I think I must pop up the poll regarding feedback about today's session.
Yes, please. There is a pop-up related to feedback. Your feedback is helpful in the improvement of our sessions. Of course, this is encouragement also. This is the true remuneration of all this effort. And thank you very much from my side. And Khyam will continue during these last moments.
So for 18% people have voted. I must say that more participation is needed from you guys. I hope you guys will turn up and participate in this poll question. As you can see now, it's about 1 minute and 20 seconds since the poll have popped up. So I'm going to close this poll in a bit. So please submit your feedback. Okay, I'm going to close this poll now. Thank you, everyone. We have 41% people saying excellent, rather 53% people saying very useful, and 6% people saying good.
Thank you from my side.
And the trainer have conveyed his thank you to everyone who is attending this session. And in the meantime, I'm going to pop up another poll question, and this is about your current residing country where you are residing right now. I'm going to launch this question now. Since our last webinars, we have found that approximately participants from Pakistan and Middle East are alike, like they are almost same percentage. Currently, there is a, I must say that there is a challenge between both, going neck to neck. And the people who are from other area, they must comment in the question box or maybe chat box mentioning their country from where they are currently participating. I am going to close this poll question in a bit. I hope you guys will submit. So far, we have 19% people who have voted for this. Okay, so I am going to close this poll question now. The statistics are that 43% people saying that they are from Pakistan, while 46% people saying that they are from Middle East. So hats off to Middle East that even after being at a distance, they are reaching us and they are trying to connect with us. While 3% people are from Sri Lanka, 7% people saying Bangladesh, and 1% people saying others. So I am going to see that. Okay, so no one have indicated that from where. Nobody have tried to contact us in chat box. Okay, thank you everyone, and thank you once again from the trainer. And I hope you guys will come up again because we have back-to-back sessions tomorrow. In fact, Thursday and Friday we have back-to-back sessions on financial instruments. I hope you guys will come up again and participate. Thank you everyone. Allah Hafiz. Goodbye. Fi aman Allah.